Hey there, welcome to the Guaranteed Retirement Guy Show. My name's John Stevenson, and today we're going to be talking about if an annuity will protect you when the market crashes again. Okay, it's not really an if, it's when, because the market does crash. We have days where it crashes hard and days where it doesn't, and then we have years sometimes where it will go down for a while before it recovers. Sometimes it might go down for 6 or 7 months and then take another 6 or 7 months just to get back up to break even. So, and of course, during the lost decade, you had the tech bubble and then you had the crash and then it went up and then you had the huge crash from the housing. And then finally it got back up to the break even level there where it was 10 years earlier. And it hit that around 2011. So you look at that and you're thinking, man, how did annuities do during that time? And if I own one or if I'm thinking about buying one, how is that going to do when the market crashes again? Okay. There might be small crashes, might be small recessions, might be a big recession, might not be. But there will be times where it does go down and it is bothersome when you are retired and you're thinking, man, I'd like to have some protection from this, but I still want some growth, right? What happens to these annuity contracts? Maybe you're just in the beginning of your search and you're looking at these and you might be listening to lots of different advisors and everyone has their opinions. Okay. Everyone has an agenda. Okay. They all make their money in certain ways. Okay. If you keep your money with an advisor who manages your money, they're going to get a regular fee every year. So a lot of times they do not want you to buy an annuity because of that. Okay. And maybe they're just all for growth and growth. And I love growth too. But at the same time, it's nice to have some guarantees as well. So you can kind of have both if you want. So then you got other advisors that are like, all I want to do is sell annuities because I make tons of commissions and that's all I want to do. Well, guess what? Disclaimer, I sell annuities and that's all I do. Okay. But at the same time, I don't think an annuity is right for everyone. Okay. So what I'm here for is I'm here to help you. If you choose to buy an annuity and you want that as part of your portfolio, I'd love to help you. So I think there is room for annuities in your portfolio if you're looking for growth, if you're looking for market protection and you're looking for guaranteed income. Okay. Annuities can be great. Okay. They're not the best option for growth. They're not a cure all for everything, but they absolutely can fulfill a purpose. And they're a tool, a solid tool in our retirement to protect us and to give us the guarantees that we're looking for. Okay, so I'm going to share my screen. I'm going to show you what these look like. And I'm going to show you what they look like when the market crashes, okay, and also when the market goes up. So I'll show you some income options. We'll talk about those as well. And if you like the video, make sure you like, subscribe, share. Make sure you comment below. If you want to book a call and you're thinking you'd like to purchase an annuity with me, then I'd love you to book a call. There's a link below this, and there's a link on my website, johnstevenson.com. You can play with my annuity calculators there as well. And just, kind of play around and decide, is this something that you want? Do you feel comfortable with it? And do you feel comfortable talking to this guy, John Stevenson? If you do, then book a call. If you don't, that's fine too. Okay. You know what? There's a lot of advisors out there. I really think you should just work with who you're comfortable with. And so I'm grateful to be able to work with so many of you and to be able to help you with these. And I try to be as transparent as I can, because if I'm putting $500,000 into something, I would want to know all the options that are out there before I make my decision. Even if I trust my advisor, it would still be nice to see what's out there instead of just have something handed to me. Like that happens so much to my clients where they're pitched this one option or 3 options and that's it. And they're just not given the full complete picture. And it's really hard to make a good sound decision if you're just getting, just a very narrow vision of this one product when there's like 70 around you. Okay. So, all right, I'm going to share my screen. Let's talk about this and we'll see kind of what these look like with market crashes. Okay. All right. So I pulled up, and I want you to see all of these options with Lincoln. I pulled up Lincoln and there's thousands. I'll show you those too. The reason why I pulled up Lincoln and Delaware are probably my favorite for growth and market protection, but growth, like indexed growth. Okay. I can show you some MYGAs. I can show you some income ones here, but I just want to give you an idea. If we're comparing, we're not really comparing apples to apples, but this is as close as we can get. Okay. We want to get as much index growth as we can. We want to get that market protection though, but still have some of the market gains, right? But we're not getting all of them. So how can we get the most? Well, the best way to do that, in my opinion, is to first pick a company, and I represent over 70, pick one that is good for growth and with the right index and has a reputation of keeping their rates pretty steady year over year. Doesn't mean they won't lower them, but if they do, it's not by much. Okay. Lincoln is one of those. Delaware is another. National Life Group's another. There's like 5 companies in all that I would recommend for their reputation. Doesn't mean they won't lower the rates, but they have a reputation of keeping them pretty steady year over year, which is really, really important when you want growth and you're getting these illustrated projections. You want to make sure you actually get what is being projected. And a lot of these annuity options, they'll project 50%, and that'll never happen. Okay. Plan on 6 to 8%. Okay. That's what I would plan on. It just depends on the company. All right. So let me show you this. This is with Lincoln Financial. They're giving you 55% of the S&P 500, and it's going to do a point-to-point for 1 year, meaning they're going to capture whatever that index has done for that year. So you buy it in February, it's going to go from February to February, and it'll measure that index during that time. Every crediting period, you'll get whatever that is, whatever the growth is, subject to the participation rate. Okay, so looking at this, we're looking at $300,000. If it doesn't make anything, if we have a long recession, you can see it does nothing. Okay, if we have like a long bear market, the worst that could happen is that 300 grand stays the same. The death benefit goes up. That's kind of nice. They do give you that just for letting it sit there. But this is a very much a worst case scenario. I've never seen this happen, but it could happen, and you have to illustrate it. Okay, so these are the guaranteed values. Okay. Now you look at hypothetical values. This is based off of what it's done in the past. Okay, this is based off of real S&P 500 returns subject to a 55% participation rate. Okay, that's important. But even with this, it's pretty decent returns. Look at that. Over 10 years, that 300 grand doubles. Okay, it grows to like 652. Yes, you can do better in the stock market. People tell me all this time, I know you do better in the stock market. You're not doing this to beat the stock market. You're doing this for some market protection and some of the gains. You're trying to maximize as much of the gains as possible, but still have protection against market crashes. Because, let's just pretend, okay? Pretend we're back in 2001, okay? Or 2000, okay? The tech bubble burst and there was a huge crash, okay? And you just bought your annuity, all right? Well, if you look here, you can see the credit interest rate was 0 because guess what? They weren't in the market either. They bought call options with the index, but the index dropped through the floor. And they're like, well, we're not going to exercise those call options. So we're going to lose the premium that we spent to purchase them, but we're certainly not going to exercise them. So they're not losing any money, and neither are you. Now they buy more call options, okay? And then, of course, the market recovers. Now the market recovers, and they give you a portion of it, okay? Maybe it doesn't recover very much, but they get whatever, let's say it recovers like 11 or 12%. See, the next year you get like 5.76. Okay, great. So you got that protection. Everyone else that, had portfolios that dropped through the floor, it's going to take them a few years just to get back to where they were. You didn't have to make up for it, because you just stayed where you were and then you got a little gain. So instead of riding the roller coaster, it's more like stairs. You're going up, sit there for a while, wait for the bear market to ride itself out, go back up, sit there, or whatever. That's how it works. So you look at this and say, well, we have a couple years in a row, then I'm getting some gains. My account's now up to 351. Okay, and maybe I have another year where I can't get any gains, but I'm not getting any losses. Okay, and then you got another nice few years of really good gains. You're like, wow, this is great. This is great. I'm making all this money. My account's like 500 grand. Okay. Now contrast this. Okay. This illustration is actually showing on the 8th year, and we'll just contrast this to like 2008, right? So let's say 2008, everything's great until it wasn't, right? Everything just really dropped, like crazy dropped. Okay. Your account balance in the market was definitely higher than this 508. Okay. Maybe it was 700. Okay. But then the market dropped pretty hard. Okay. Now your account balance is at $320,000. You're like, oh man, that is horrible. What a horrible feeling, right? But if you had your account in an indexed annuity, which many people did, then what happened? Well, it just stayed there because guess what? The call options were not exercised. Okay. They expired worthless, and the insurance company bought some more for the next. So while all the rest of your friends had their accounts balances going down 50 or 60%, your account stayed at $500,000. Yeah, they were higher than you before, but guess what? You didn't have to ride that big roller coaster down with them. Okay. And so when the market recovered right after, you were able to take advantage of all those gains right after. And so you can see here, in year 8, you didn't make anything, right? But you didn't lose anything. But then after that, it just keeps on stepping up. Look at that. Some more growth, some more recovery. While everyone else's accounts is just clawing just to get back to break even, you're already above that and you're still growing. Eventually they will beat you again, right? So just keep that in mind. Disclaimer, they will beat you again someday. But guess what? You didn't have to ride the roller coaster, and you were willing to not have as huge of a gain over the next 10, 15 years because you didn't want to ride the roller coaster. You wanted some growth and you wanted some protection. Okay. That's how it works in a crash. Okay. All right. Now I'm going to show you income. Income is the same way. With income annuities, they give you lifetime income. It's guaranteed. Okay. If you had an account portfolio of $1 million during the 2000 to 2011, you had a big roller coaster. And if you're taking out 4% safe withdrawals, they weren't so safe anymore because you had a few years where your account balance dropped to like 400 grand. Okay. And now all of a sudden, 4%, you can't do that no more. You're like, I got to take 1% or 2%, maybe. Right. And now you need more income. And it's like, it's just my wife's uncle. He lost everything. Okay. This is exactly what happened to him. Okay. Thought he was going to retire and everything was going to be great until he didn't. Okay. So, all right. So let me go into here, go in the income rider. That usually pays the most. All right. New Jersey, 300,000. If you start income immediately, let's see here. Yeah, you got some of these ones that pay a little bit higher, but then they reduce. Let me get rid of those. Get the ones that are the highest here that never reduce. All right, so keep in mind you're retiring at 62, so you're considered young. You may not feel like that, but it is young. Okay, $300,000 is going to give you $22,000 a year guaranteed for the rest of your life from Prudential. Okay, but if you're like, well, I'm going to retire at 65. Okay, I'm going to work for 3 years, retire at 65, but I want to protect my money from market risk. I want to also lock in some guaranteed income. Well, you can do that. Now it's $29,000. Pretty good. Okay, let's say you pick Nationwide because they're the A+ one. Okay, well, we'll just grab that, and I'll show you. They don't give you a ton of the market. Okay, this is an income product. When you look at income products, they're all about income, not growth. Okay, so they show you, here's the worst case. Worst case is, well, your account balance goes down by the time you're 74, but the lifetime income is why you bought it, and that's what you get. Okay, and then you see your rider charges right here. Those come out of the account balance here. They don't come out of the income. So it makes sense for many, many people to get this because that's exactly what most of us are looking for. Now we'll go down and we'll say, okay, well, what does it look like with growth? Well, they're not giving you very much the S&P. They're giving you like 6%. Okay, so they're capping it. And that'll last a little bit longer, to 77. So what'd you get? An account balance and a death benefit, right? That lasted a little bit longer. So that's nice. That'll probably materialize, but you never know. Either way, though, the income is why you bought it, and it's guaranteed. So you spent $300 grand for a $900,000 pension by the time you're 95. You live longer, it pays out more. So this is for a single payout. For a joint payout, it could be different. It just depends on your spouse's age. But that's how these work. Like they protect you against market risk. They invest in call options on these as well, and they give you a little bit of the growth, but not very much. Their big focus is on lifetime income, and that's why you buy the rider, is because that is for contractual guaranteed pension income. That's what it's for. Okay, it still protects your money against market risk. That's what it's designed for, but it's really designed to give you that lifetime income as well. So it keeps that portion of your portfolio out of the market, allows it to give you the income that you work so hard to build it up to so you can have that income. And then if you want to let the rest of your assets grow and ride the roller coaster in the market, you absolutely can do that. And so I have many clients that will do just that. They want to have that growth, cover against inflation, things like that, and even buy more annuities later on to stack their income. But they'll usually buy a base with a portion of their assets to give them that income so they can keep their lifestyle and be able to enjoy their retirement. So when the market crash does happen, they're not like sweating over that. They're like, yeah, my other account went down a little bit, but I'm sure glad I got this annuity paying me my income because I could still go to Italy, right? I can still see my grandkids. I don't have to go back to work because I covered myself. Okay. That's what you're doing. You're covering yourself. You're hedging yourself. Okay. You're protecting yourself. So anyways, I hope this helps. If you like the video, like, subscribe, share. If you want to purchase an annuity with me, I'd love to help. There is a link below this video, goes directly to my calendar, or you can go to my website, johnstevenson.com. You can check out the annuity calculators and you can book a call right there if you like. If you don't, that's fine too. I am here to help, and I would love to help you if that is something that you feel comfortable doing. So anyways, got questions, comment below. And I really appreciate you watching. I hope you enjoy the channel, and I hope you get a chance to kind of browse through the other videos because there's just a lot of videos in there where I share stories of people that I'm helping, and I answer questions. I answer lots of questions because these are real questions people are asking, and so sometimes I will answer the same question more than once because many times my videos will get buried down in the bottom, and I got to create another one about the same subject. Because a lot of times people can't find that, and that's what I'm here for, is I'm here to answer those questions. Even if you keep asking them over and over, that's what I'm here for. So hope this helps. I appreciate you, and we'll see you next time.